Today, we want to focus on an additional weapon in your arbitrage or arsenal, and it's this one down here, which on my pair charts here is in the bottom left chart position, and that's the relative strength index filter. So what is that? Let's take you through it. So when do we know that the irrational pricing has gone far enough? Will it keep going and drive you into painful losses? You want to catch the mean reversion without getting swept away. And how do you find the balance and time a good entry? So this is a critical question for the pair trader. It's like watching a wave crash on a beach to identify the moment the wave reaches its furthest up the sand and turns and runs back down. You don't want to get washed up onto the shore. You want to ride this back into the ocean. The reversion to the mean. So enter PairTrade Finder Pro's RSI filter. The RSI, or Relative Strength Index Oscillator, was developed by famed technical trader J. Wilder in 1978 and has been making money for traders ever since. It's a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100, and traditionally, the market is considered overbought when the RSI is above 70 and oversold when it's below 30. With PTF UA3 and in your own trading strategy or system, extremes can be set at 80-20, 70-30, 85-15. You can put them wherever you want. As price ratio reversion to mean traders, what do we use the RSI for? We use the RSI to determine the strength of the trend in the price ratio of a stock pair, and very importantly, to help predict how likely its trend is to change. So, when has it come all the way up the beach and is about to go back down? Now back to tall poppies in the RSI. So PTF UA3's RSI filter allows you to filter out any trading signals that are generated when the RSI is not at an extreme, both in your backtesting and on your watchlist radar. The filter ensures that when you do enter a pair trade, you are only cutting tall poppies, that is, RSI readings that have stuck their heads way above or below the parapet. Here's an RSI filter. You can see these are the extremes. So the filter makes sure you're only entering trades when you're at these extremes, when every other filter is being met as well. Okay, so if we have here pair STM, XL, and X, okay, and we're looking at this over the last year. So here's the moving average of the ratio, nice and flat. Here's lots of zero crossings. We're seeing extremes here, and there was, let's look at this one here to show you how the RSI filter works. So this was a big drop down in the price ratio. And if we look at the plus minus, this is our standard deviation filter. So we're taking an entry stretch of 2.7 plus or minus to get into a trade. Okay, this broke 2.7, so there should have been a signal here. However, with the RSI filter as an additional layer of filtering on top of just your standard deviation entry stretch, and it was applied with 70 and 30 extremes. What you see is that when this one broke 2.7, no signal was called. Why? Because it was still not below 30. It hadn't stuck its head below the parapet, so to speak. So what happened? Ratio started to revert. Then I spent a few days thinking about it more. So it started to revert to mean spent a few days thinking about it, boom, and then dropped again. So if you were in this trade here, this would be a massive loss that you'd be looking at. And if you're trading at $10,000 a leg, I don't have the numbers, but that could be $1,000, $1,500 of red ink sitting on your watch list. That's a very uncomfortable position to be in. Okay? And then even when it reverted, had you entered here, you had only a minor profit. Well, maybe a couple $100. However, had you entered here, you had a massive profit. So what does the RSI filter do? So when this extreme was reached, no signal was generated. But then when it decided to travel way further down, that did generate a signal. And why is that? Because on the RSI filter, it had gone below the 30 extreme level, and therefore this filter was met. And the RSI filter was met, therefore a trade was called. And look at the difference between your entry. Had you entered on the first one, you were here, took a massive loss in the face, and then when it did revert, you made a little bit of money instead. On signal 2, you entered here, had no loss, no running loss on the trade, and then very quickly made a large amount of money. So that's taking you through, just a little bit, how the RSI filter works. The other thing I wanted to touch on is the RSI chart allows us to look for divergences between the behavior of the RSI oscillator and the price ratio. These divergences may signal a greater probability that the wave has run all the way up the beach and may be about to turn around. So we don't have it here. I can't see the divergence here. But let's look at this one, for example. Now we have a standard deviation filter of plus or minus 2.7 standard deviations. So it didn't call these trades because they only came to about 2.5 here, maybe 2.4 here. But let's say that it had, and let's say it had called a trade here. Would you have taken it? Maybe. But it calls a trade here. Let's say that happens. Would you take this one? Well, if you look for something called divergence, you can see that the price ratio is making a low and then a much lower low. But if you look at the lows on the RSI chart, it's making a low and then a higher low. So this one's a lower low and this one's a higher low. You can see this black line is just underlining those. That's called a divergence. And Perry Kaufman looks at this technique in trading systems and methods. He tries to quantify it even as some code to measure when this is happening. However, if you look at it visually, it's probably still the easiest way for a trader to determine whether there's a divergence. You can see it on the chart. And what that means is when we see a divergence like this, we believe it increases the probability that that wave has reached all the way up the beach and is about to come back down into the ocean. So to us, it's another signal. It helps us measure that. We think the wave is crescent and is coming back down. So that's how we use the RSI filter. So let's take a look at an example of the RSI filter in action with a specific pair and what it does. So the charts below show the comparative results of a backtest of the stock pair. Allison Transmission, ALSN versus Autoliv. Okay, ALV, the first backtest, which is over here, uses no RSI filter. The second backtest adds an RSI filter with extreme set at 70 and 30. Note the increase in profit, decrease in max drawdown, and even though the same number of trades were entered, the improvements result from catching the entry closer to the point where the wave is exhausted. So let's look at this first backtest. It was 2 years. Look back, you had 5 trades. This is a highly co-integrated pair with a 58% correlation as well. So if you just kept your capital in that pair, you had an 11% compound annual growth rate, but you had a 15% max drawdown, so negative reward risk. And you made about $2,346 in backtest, an average net profit of about $469 a trade, and 80% were winners. And here you see the P&L curve, the equity curve. You can see this big drawdown here, another pretty big drawdown here, and as well here. So what happens when you add the RSI filter? You still have 2-year look back. You still have those 5 trades, and you still have the same correlation and co-integration because we're trading the exact same price series, right? But the compound annual growth rate of your strategy has gone up to 19%. Your max drawdown has gone down to 8%. Now you're a 2-to-1 reward risk. The total net profit you pull out of this pair is $444 versus $2,300, and your average net profit per trade is $829 versus $469. And most importantly, we highlight this trade here. Look how when we're talking about this maximum adverse excursion, so you got into the trade here and you took a major low loss, it went all the way down, $1,500 loss. That made you very uncomfortable. Did you still hold the trade? Did it trigger any mental stops for you or actual max loss stops you might have in place? And then it reverted and made another $700. Pretty uncomfortable trade. However, if you use the RSI filter, you got in, there was no maximum adverse excursion, and you made about $2,200 on one trade. That's a very different trade from a trader's perspective, psychologically, and on your P&L. So what's our conclusion? If you're going to practice the art of imperfect arbitrage, which is how we think of stock pair trading, you want the best tools in your arsenal to manage the risks involved. The use of the relative strength index filter integrated into your PairTrade Finder UA3 is an excellent example of a tool that can help you reduce losses and maximum drawdowns, increase the profits, improve your reward risk from the same trading opportunity set, help mitigate occasional large losses, and thereby improve the psychological profile of reversion to mean trading. And what does that mean? This will bolster your trading confidence. So there you have it, everyone. The art of imperfect arbitrage and the relative strength index filter. Thank you for joining us.